All right, so I'm going to get us started right now, guys, and welcome everybody into the meeting. Hopefully, they are able to hear just fine at this point. So, welcome everyone. I appreciate you joining me this morning for a conversation with Chris Cook of Beacon Capital Management. We have Matt Goeller from Vanguard Investments joining us, and a very special guest star for this video conference today. We have Paul Woolhouse, the 2020 Tranquilli Financial Advisor intern. So a few housekeeping items, if I may, as we always get these started with. The first is you'll notice in the upper right-hand corner of your screen that you're able to view the video conference in either speaker mode or panel mode. Speaker mode will put the person asking or answering a question front and center on your screen as they're asking or answering that question. The gallery mode will allow each of the participants to show up on your screen as a panel. The Brady Bunch view is what I've called it in the past, and we'll call it again that right now. So I do have a few things, and if you do hear some beeping, it says I admit people because we did make this an invite-only opportunity. So my apologies if you're hearing some beeping in the background. That'll stop in not too long. I do need to read the disclosure document that you're seeing on your screen now, I'll take care of that. So this webinar is created in May of 2020 and is provided by Tranquilli Financial Advisor, LLC for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or the offer to sell any product. Tranquilli Financial Advisor, Beacon Capital Management, and Vanguard Investments reserve the right to modify their current investment strategies and techniques based on the changing market dynamics or client needs. There is no guarantee that their assessment of investments will be accurate. The discussion, outlooks, and the viewpoints featured are not intended to be investment advice and do not take into account the specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. And of course, past performance is no guarantee of future results. My apologies for looking in the other direction as I read that off a separate screen. But with that, I will ask all of you to join me in welcoming our guests. Our guests are, I'll start with Chris Cook, and I'll bring over his bio for you. Chris Cook is an entrepreneur, and he's an investment manager with a strong proponent or propensity for improving investing outcomes with the application of scientific fundamentals. He's the founder and president of Dayton, Ohio-based Beacon Capital Management. Chris is also the author of a best-selling book, which is Slash Your Retirement Risk: How to Make Your Money Last with a Simple, Safe, and Secure Investment Plan. He's a graduate of Bowling Green University with a Bachelor's of Science in Business Administration and a concentration in finance. Also joining us is Matt Goeller. He is a senior ETF, which is Exchange Traded Fund Product Manager in the Portfolio Review Department of Vanguard, where he's responsible for reviewing and improving the competitiveness of Vanguard's ETF lineup and supporting Vanguard's ETF investors. Before Matt's current role, he led the development of product strategy for Vanguard's engagement with intermediaries. Matt's previous roles included sales analyst on the national accounts team with Vanguard, financial advisor services, and as an analyst in Vanguard's institutional advisor services, working with endowments, foundations, and pension plans. Matt joined Vanguard in 2006. He earned a BA and a BS from the University of Maryland, and he's also a certified financial analyst charter holder. Additionally, we have our 2020 intern. The summer intern is Paul Woolhouse, who's presently attending Carnegie Mellon University. He's a finance major in the Tepper School of Business, and he accomplished Dean's Honor List in fall of 2019. I would want to say welcome to all of you, of course, and thank you for being here. thing that comes to mind right away, if I can, is that Mom Tranquilli taught me well. Bring really smart people in and let them be really smart. So that's why you're all here today, and thank you for joining me. So I've got some questions that we prepared for the conversation, and let me just grab those. And again, if you hear some beeping during the video conference, my apologies for that right away, as I allow other people into the video conference while it's going on. So I am having some technical difficulties. Chris, I'll start off with you. If you would, just the concept of beacon capital management. We've talked with a number of clients in the past. Many have heard the story of Beacon, but I always think it's a good idea to reaffirm the concept behind Beacon capital management. I think at the current time, COVID-19 markets, the downs, the ups, if you would, just provide us the concept and the start to Beacon capital management.
Yeah, thanks, Lou. Thanks for putting this together for us, and everybody that's attending the call. We appreciate that. But yeah, Beacon, started back in 2000. So it was one of the more recent bear markets that we've had in our history. At least most of the investors we work with today, they remember that. The tech bubble, .coms, blew up, and all of our portfolios have been built for retirees from the very beginning, so that they've always had a defensive slant. But after that, we became more conservative, a little bit more aggressive with trying to defend against the losses along the way. And that proved itself out fairly well in 2008, the next bear market, when the financial crisis came along. But even at that time, we found that there were some investors that were still too nervous. It was too big a drop for them to be able to withstand and stay invested, which is the most important thing. So, we built the current version of our portfolios right in the middle of that 2008 market as it was happening. So most of your clients that we've talked to in the past, they probably hear our 10% stop loss. That is still our flagship portfolio, but we built out some additional portfolios along the way, all centered around defending against losses. Losses are more powerful than gains, and that's still where we're at today. And for the most part, things have worked out as planned, even with the coronavirus.
Okay, and Chris, I appreciate the background, of course. Matt, as someone who has worked with financial advisors in the past as part of your role at Vanguard, and now part of working with intermediaries and the overall strategies of ETFs that are provided. It's a concept that Vanguard is, if you will, a part of a team member, if you will, with Beacon Capital Management, the chosen investment vehicle being Vanguard ETFs. If you would share your thoughts on the concept of providing downside risk on something like a Vanguard ETF by another money manager, such as Beacon Capital Management.
Yeah, good question, Lou. And first of all, thank you all for engaging with us. Thank you, Lou, for hosting us and having to hear what Vanguard has to say. The webinar format, it's just so different from what we're used to. I know it's hard to replace face-to-face engagements that we have with financial advisors or investors, but I think that the way to use technology to reach a bunch of people is really pretty fascinating, and definitely a new way that's worked out pretty well. And maybe tangential to that, please let me know if you have trouble hearing me or anything. And obviously,
just fine.
Talking great. So, to get to your question, Lou, how do we think about risk management at Vanguard? I think about it I think there's three different ways we can touch on it, and I'll hit each briefly. So one is, we think about, or at least from the perspective of somebody building a portfolio or putting a portfolio together, is what is the ETF? So the exchange traded fund, what type of exposure is it providing, and how does that interact with the other investments in a portfolio from a risk standpoint? Two would be, as a fund manager that offers a lot of different funds that Vanguard does, I'm sure you're all pretty well aware of the type of company we are. We offer mutual funds and ETFs. How do we think about our lineup holistically in a risk-aware way? And I can touch on that briefly. And then finally, how do we integrate risk management into the actual management process of the actual running of the funds on a day-to-day basis? So on the first one, if you think about how to consider risk in putting a total portfolio together, and in a sense, this is the type of work that Chris does in building portfolios. It's kind of a recognition that when you think about reducing risk from a total portfolio perspective, it's kind of the instance where the sum is greater than the individual parts. And what I mean by that is if you're putting together a series of investments and funds that each on their own may have some element of risk to them, as every investment does, if they're not moving in the same way or even move in opposite directions at any given time based on how the markets are interacting with one another, then your overall risk is lower if the correlation between them is not as high. So the way that we would provide support to an advisor or an investor or a strategist that puts together a portfolio is helping them understand what's in the Vanguard portfolios. And that's something that I do on a daily basis, really talking about the composition of the funds that we run. Secondly, I mentioned Vanguard thinking about the kind of the whole lineup of funds that we offer in a risk-aware way. What I mean by that is that it's not like Vanguard doesn't offer funds that have an element of risk to them. I mean, geez, even the 500 index fund has risk inherent in it, of course. But when we think about the lineup, we are going to really be thoughtful about offering investments that have too much risk implicit in them, or risk that may not be commensurate with the type of investors that we want to work with. So, for instance, we don't have a lineup of funds that invest in individual countries in emerging markets that each on their own might carry a level of risk that probably goes beyond what a lot of the investors that we work with might be comfortable with or might be educated on understanding. And then finally, the idea of how is risk integrated into the management of portfolios more on a day-to-day basis. I would say it's heavily integrated. The idea of risk management goes alongside portfolio management at Vanguard. So we have an independent team of analysts who assist the traders and portfolio managers who run our funds. And the assistance that they're providing from a risk management perspective is understanding how each trade that we make contributes or detracts from the fund's overall risk profile. Maybe a simple example would be if you're running a bond fund and you have $1 million to put to work and you know that you want to put it into a Coke bond or a Pepsi bond, just really basic example, because you want that type of sector exposure or that type of maturity. The risk management team can help understand what are the risk characteristics of Pepsi versus Coke and how do they interplay with the other bonds in the portfolio and the market environment at any given time. And that's the type of independent analysis that gets layered in. So, I think, Lou, that's maybe a little bit of a lengthy answer to your question, but when you think about how Vanguard thinks about risk, those are three really basic ways that I think kind of all come through in the way that we provide funds that ultimately make it into investors' portfolios.
All right, Matt, no comment too long for the clients that are here who are all part of using Vanguard as part of it. I'm glad you brought up the bond market or the bonds as part of your example, because that's where I would like to go to next. In previous conversations, we have spoken about bonds. I would like your analysis of that as well, Matt. If you would just take us through the initial days of the COVID-19 drop in the market. Now we're going back, about 7 weeks, six, 7 weeks or so ago, looking in reverse, saying what happened, because days afterwards, and Chris will get to you on this as part of it, but for some days afterwards, there were, for lack of a technical way of stating it, shaky days in the bond market. Bond valuations dropping rapidly. How did Vanguard handle that? What measures were taken? What happened inside your funds or ETFs, please?
Yeah, great question, Lou. And even though it may have been 7 weeks ago, or 2 months ago, I feel like the memory of some of those days in mid to early March will probably be memories that I had throughout the rest of my career. Just
A good thing.
the engagement with my colleagues and the clients that we work with, certainly an interesting time to say the least. And it was all what I think what was fascinating about it was even when we were in a time when the stock market was dropping, a couple percent a day and had been down, say 20%, then getting close to 30% by mid-March from the beginning of the year. Despite the fact that my job domain covers stock funds as well as bond funds, most of my time was spent addressing questions on bond funds, which I think really gets to the maybe the suddenness or the surprise, in a sense, of the liquidity shock in the bond market that happened, which is and has been remediated now. We can talk about why that's the case. But, essentially, I think early in March, getting, first couple of weeks there, you began to see some signs of stress in the bond markets, maybe late in February and then first couple of weeks in March. And then by the middle of the month, there was what was, and I don't think this is complete overstatement of the term, I think kind of a corporate run on the bank, so to speak. So what that means is that large companies and certain large institutional fund managers, like hedge funds, for instance, really began to draw down on their lines of credit or began to seek ways to convert their really short-term bond investments to cash all at once. And the magnitude of that and the speed of that really played a little bit of havoc with liquidity in the bond market and the shape of the yield curve. And some fairly odd things occurred. For instance, you saw very short-term bond yields rise above those that might have been more intermediate or longer term, despite the fact that it was very much a flight away from risk. And typically you think that shorter term bonds are less risky and therefore could have lower yields in an environment like that. But I think what you saw was, or the reason that was happening, was that the selling pressure on those shorter term bonds was just so great in those couple of days that it drove the yields higher. And the sell pressure was great because they were the most immediately liquid instrument to convert to cash. Additionally, too, you saw bond ETFs, which is really my domain of expertise. You saw their market price become a little bit dislocated from their net asset value. So if you're familiar with mutual funds, they have an end of day net asset value that you transact at. ETFs have a struck net asset value as well, but you transact at a market price. And typically what we see and observe, and simple mechanics make this true, is that the bond ETF is the more accurate and appropriately representative price, judging real-time liquidity and real-time value for a bond portfolio. So when you saw the market prices of the ETFs become a little bit dissociated from their net asset value, I think that really gave a clue as to what the true value of bonds was at any given time in those couple of weeks. Now, I think what subsequently happened was that the Federal Reserve Bank had been very vociferous and active in their intervention in the markets. Their goal really was not just to, say, prop up returns, but it was to restore a semblance or restore functionality to the way the market worked. And their purchases of treasuries and mortgage-backed securities, which harken back to the days of the financial crisis in 2008, that was something that they did, and I think that was effective to a degree. But what really turned the tide, I think, in terms of liquidity for the corporate bond market, and then had a lot of good add-on effects, was the Fed's announcement that they would also support the corporate bond market, and even by using corporate bond ETFs that Vanguard manages as a mechanism to do that, or an avenue to do that. And just that announcement of them being willing and able to do that immediately almost restored liquidity in the market. And what we've seen in the couple of months since, or the several weeks since, is companies feel really good about using the bond market to obtain financing. So what we call new issuance. So new issues of bonds to market have actually been record-setting in April and May. Performance of corporate bonds has been, it has revived and been more like treasuries and actually kind of outpaced the losses that they had incurred. And flows to funds that invest in corporate bonds have picked up as well. So, I think that there has been certainly a rectification of the liquidity and structural challenges that spiked up so rapidly and surprisingly in March, and definitely a good sense of normality to the functioning and the expected relationship between risk and reward and opportunity in the market since then.
Okay, and I do want to get back to exchange traded funds, have a conversation about the stock-based funds. Now, you are, I'll say, Matt, on the technical side of it. Chris, of course, is technical, and we haven't heard from him in a little while, so I don't want to bring him back in right now. And Chris, as the person, again, who's designed a risk mitigation based portfolio, you are watching as an investment manager, advisor for client portfolios, as the bond market, which we are going to for safety, suddenly begins falling and falls rapidly at the time. Your reaction and what ultimately happens within Beacon as well, because I think that's a bit of an, I'll say, an unlocked or not discussed enough secondary method of protection that you've added to your portfolios as well. I'd like everybody to hear about that.
You're right, Lou. Just about everybody talks about our risk mitigation on the equity side. So when stocks drop by a certain amount, we automatically go defensive to try to protect clients. But all of the portfolios also have a second line of defense, which is on the fixed income side that we're talking about now. And it's not talked about a lot because it really doesn't happen, very often. We happen to go through a period of time that was unprecedented in our lifetimes anyway, on the fixed income side. We're talking about, not to get too technical here, but the volatility on fixed income, was reaching about 10 or 11 standard deviations from normal. And just to put that in perspective, that means it's supposed to happen about once every 500 years. We saw some extreme volatility, and the portfolios are rules based, and they did trigger all of those defense mechanisms on the fixed income, side, slowly but surely. Now it turns out, as Matt had talked about, the Fed really stepped in a big, big way to try to stabilize that market, and thankfully they did. And those defense mechanisms on the fixed income side, we're starting to peel those off, slowly but surely. A lot of our bond portfolios are back to being fully invested, and clients are participating on that side because the Fed is creating a lot of liquidity and demand on that end of things. So that's been very helpful for us.
Good. All right. So if I can just make this comment about the, I'll use a visual, the levers. There were multiple levers going on that really no one had access to, Chris, I'll say, other than you and what it looks like, obviously your team and you. If it's a once in every 500 year event, I can't decide if I do or I don't want to be around for the next one. But the bottom line is this really is a once in a lifetime occurrence as it applies to the bond market. Is that, I mean,
yeah.
For the sake of compliance, a prospective once in a lifetime event that occurred.
Exactly. And, I'll throw my vote in. I hope I don't see it again. This is one of those things where, we have rules built for covering most of history that will satisfy most of those scenarios. But when you have something that happens, like I said, theoretically once every 500 years, well, you can't really build a portfolio to handle that, in a perfect way, because if you do, honestly, it won't work any other time. That causes a lot of stress in a portfolio. So to go back to an old football term on defense, bend but don't break. Well, the portfolios on that fixed income side, they did bend a bit, but thankfully, they didn't break. The defense did work, and it stopped the portfolios from dropping, as much as the overall market did.
All right. Well, and Matt, bringing it back to the exchange traded funds, the stock-based exchange traded funds, clients have heard in the previous video conferences that we've had about the bond market, and your comments on it are appreciated. And they're the third time that they've heard it, and I think it's important to hear. The other side of the coin, if you will, are the stock exchange traded funds. And if I could just take a moment to share what an exchange traded fund, what it is, because a lot of people are familiar with mutual funds, where you mutually share in the value of a fund. You don't own any of the underlying securities directly. They're familiar with stocks, where you buy the stock and you own the stock. So pick whatever name that you want to. You're the holder. You can watch that stock. ETFs, as I've described them over the years, are right in between, where they're a grouping of individual securities that the client owns somewhat indirectly, but directly. They are theirs. Meaning it's not commingled with other client exchange traded funds that they own, but they are their own securities. However, instead of owning an individual stock or a few individual stocks or thousands of issues, if you will, through the mutual fund, they own a basket of stocks in each ETF. So there were, I think that was a good description of an ETF, and you're welcome to correct me if you'd like to add anything to it. But the ETF market, the stock ETF market, had its own, I'll say, wavering moments. How would you say that it held up? Because this really is the first time, Matt, that we've had extreme pressure on ETFs during a market. 2008, they were fairly new. They've been around a few years, but now we had a real test of the ETF market.
Yeah, Lou, I think your description of what an ETF is relative to a mutual fund was spot on. I tend to describe them as the fraternal twin of a mutual fund, in that, really, if you think of a mutual fund as a pool of money that invests in securities, and you have a beneficial stake in that or a partial stake in that, basically exactly the same thing, with the difference being that for a mutual fund, your investment into the fund occurs at the end of the day, and your initial value is determined by the aggregation of the value of the underlying stocks. With an ETF, you can make that investment anytime throughout the day, because the shares of the ETF trade on an exchange. And the ETF's value is going to be extremely close to the value of the underlying securities. I mean, frankly, at Vanguard, the ETF and the fund are literally the exact same portfolio of securities. So I think the fraternal twin analogy carries through pretty well. Now, how did equity ETFs weather the storm is a great question. And I would say they passed the test of existing through a market dislocation with flying colors, really the same way that mutual funds did. Several days we saw the market halt within the first seconds of opening, literally. In no case did you see an ETF's price become wildly dissociated from the value of the securities that it holds. So I think purely from the technical standpoint of, did the ETF function like it should? The answer was yes, across the board. The returns of the ETFs, similar to the return of a mutual fund, certainly you had, as we saw, anywhere from 15 to 30% negative performance, through those first couple of months. And that is, of course, what you would expect in a ETF or a mutual fund that holds a large basket or large portfolio of stocks across a variety of sectors. So performance was as expected, functioning was as expected. So I would say we were very pleased with the way that the ETF as an investment tool held up.
All right, good. So you're right. They performed as if they were the individual security that was backing them, not backing them, but they were invested in.
Yeah, exactly.
All right, good. And the reason I just wanted to add that in is this: it helps to understand what it is we own, so that we have a perspective of watching the news, hearing the news, receiving tweets, and whatever it may be that we are gathering our information from, to have a perspective of what the valuation, where the valuation is coming from. And if you're a holder of high quality, while it may look unattractive at the moment, if they're high quality for a reason. And that ultimately leads to the next question, which is this. We're now finishing our 5th month of a very unique year, to say the least. We have seen the pictures online now of Memorial Day weekend. And of course, I can't let it go by to thank everyone who served, and of course remember those who aren't here to thank. We've seen the pictures of people shoulder to shoulder at beaches. We have seen parties, pool parties, everything that we've been told basically not to do over the course of the last few months. We are seeing. Chris, if you would lead us off with thoughts about a second wave, what it means to your portfolios, and then Matt, I'm obviously going to follow up with you and say, how do you look at it from an analysis standpoint of what would a second wave mean to the market? So Chris, if you would.
Yeah, so a second wave will obviously create some more economic uncertainty, especially if it gets widespread, like we did the first phase, I guess. So a lot of companies will start to shut down, and ultimately that affects earnings. That's ultimately what we're buying when we're buying equities is earnings in these various companies. So the portfolios are built to have those defense mechanisms back in there. So if we do see that second wave, the portfolio may fall, but we'll trigger those defense mechanisms and protect clients and slide over into fixed income again, like we did the first time. And depending on the portfolios that we're invested in, some are fully invested now, but others are not. So, the idea is to kind of best practice is to diversify across different strategies and risk management systems so that we don't have quite as many whipsaws back and forth. And again, this is kind of an unprecedented time trying to figure out how this will work. We're accustomed to dealing with financial recessions. This one's unique. It was not a financial induced recession. This is a health crisis and an effective worldwide shutdown. So it's something that creates some uncertainty, but that's why you have risk management built into the portfolios.
Matt, go ahead with your view as analyst background and the thoughts of a second wave and the impact. Obviously, we'll say the impact on the market almost seems obvious. How about the impact on a recovery in the market, a second wave? What that means to look forward, somewhat crystal ballish. Let's say it, as predicted, occurs. What does that mean to the market? What does it mean to a recovery?
Yeah, it's a good question. And the one thing that Chris said that I've heard echoed around Vanguard quite a lot is it's not a financial crisis. It is a health crisis and obviously extremely severe economic situation. So, a lot of, I think, the issues that you might have seen in the great financial crisis or global financial crisis 10 years ago, 12 years ago, are in a sense perhaps not to be repeated in the sense that we saw in that time extremely high levels of volatility persist for quite a long period of time, say 2 to 3 months. Whereas here, what we've seen is that type of volatility persist for really just 2 to 3 weeks and then become a bit rectified. So bringing back some sense of normality to the markets. The situation with illiquidity, as I said earlier, was sharp and severe, but also short. I think we play the tape forward and think about what could happen. What the global chief economist at Vanguard says in terms of laying out a series of cases, so forward-looking cases as to what could happen, they don't view a second major peak driving a second lockdown as the base case scenario. Obviously, it's a risk, though. And I think our base case, which he puts a number on it as sort of like a 60% likelihood, is that the lifting of the economic lockdown that we are seeing probably by the end of June will probably not really be reinstated. But certainly it is a clearly defined risk that a second peaking of the virus could drive that. And it's one that I think he views as only a little less likely than the upside risk. So if you have a 60% likelihood of sort of this base case continuing of the lifting of the lockdown, perhaps a bit of a resurgence of the virus, but not a continued lockdown, then you probably have the markets continue to function really as normally. If your remaining 40% chances are roughly evenly split, but a little bit less so on the bad side, then I think our base case, like I said, is more or less encouraging for a continued return to normality to the markets. And of course, I grant you that our economics team are not epidemiologists. Undoubtedly, though, I think they all know a lot more terms in that lexicon than they thought they would at the end of the year. And by dint of Vanguard's size and reach, they are able to talk with some of the best disease modelers or doctors in the world. So I'm hoping that that's coming from a pretty educated place. Now, I think were there to be a second peaking that does drive a pullback in economic activity, we would obviously view the risk of downdrafts to equity and credit as returning to a much greater degree than it is right now. I think in our base case right now, even though we're not sort of forecasting another drawdown per se, certainly we forecast the likelihood for increased or a continued high volatility going forward. And volatility doesn't necessarily mean negative returns. It just means the chance for returns that are up or down of a greater magnitude than usual. I think if there were a return to a second peak, the countries that were hit hardest in the first place, like the US, would probably be those that would be a little bit more gun shy than, say, in Australia, if you're looking kind of across countries where they did not experience the severity in the first place as hard. And I think equity markets would certainly take it the hardest. I don't think that we would see a return of the illiquidity problems that we saw and that we reviewed in the corporate bond market earlier, because I think the mechanisms and the expectation that there was Fed backstop is now fairly well firmly established. And I think if you did see a rerun of the real challenges in the market, it would probably be a rerun of the specific sectors that took it the hardest. And those that might have fared the best would probably be those that fared the best again. So healthcare and technology did the best in a relative sense earlier in the year. That would probably be the case again. Energy did the worst. That would probably be again the case, especially as you see forward oil prices really kind of pricing in a bit of a rebound there by the end of the year. So I think if I were to think about it across country and sector, that would be the way that we kind of view it as a potential shakeout.
Okay, and that will lead to the next question. But before then, we all have these very low gasoline prices and nowhere to go. So you can't take advantage of them at this point, which is unfortunate. But anyway, the sectors that you just mentioned, a few of the sectors. Do you have any, if you don't mind sharing, what sectors are you most interested in right now as you analyze at Vanguard? Are you sticking with that healthcare and technology sector? And what sectors are suffering? I'll ask you this way: if there are 11 sectors in the S&P 500, how many are performing well during this time? How many are not performing well during this time?
Yeah, so I'll start. I don't know if you want Chris to follow into that, but lots of ways to take that question and think about it. Certainly where we saw the most harm was in energy. If you think about valuations and where valuations were maybe on a sector by sector basis at the end of January relative to where they are now, they're all lower, of course, but some have been hit more hard than others. So financials and energy, you saw or you see now, ostensibly on the surface, more attractive valuations there. That doesn't necessarily mean that just because the valuation is better, that it's a more likely, better investment at the moment. And I think certainly the risk that exists with energy might preclude me from saying that, as we talked about earlier, that if there would be a second peaking, you probably see a rerun of challenges there. But I think to the extent that there is some favoritism in sectors, you might think about telecom, tech, utilities, healthcare. So those that are more inelastic, those that have a little bit less risk of being necessarily tied to the economy, that's where some of the active managers at Vanguard are probably weighing their free capital a little bit heavier. And maybe another way to think about it too that I think is interesting, this comes out of our economics team, is a breakdown kind of industry by industry and saying, what are the sectors who are really bearing the burden of the economic shutdown are obviously going to be those that are the most challenged kind of going forward with regard to recovery in earnings or credit quality on the bond side. So if you think arts, entertainment, lodging, hospitality, food provision, that type of thing, their analysis would indicate that 73% of that market essentially is at a full stop right now. And that's 4% of the economy. You think about construction, 65% of that sub-industry is at sort of the full stop or really bearing the burden of the shutdown. For retail, it's about 50% stoppage rate. And collectively, those three industries that I mentioned add you up to roughly 15% of the economy. So, and that's in the US, but really kind of mirrored in other countries as well. So I think it's kind of looking at those areas where the most risk is latent, and versus the more inelastic sectors that I mentioned as those may be a little bit less subject to the potential for future volatility.
Chris, I am going to ask you to comment because in talking about the sectors, obviously that's an important part of the risk mitigation that is Beacon Capital Management's theory of investing. Equally weighted sector ETF. So if you don't mind, a little more detail on that for everyone.
Sure. Yeah, well, as you mentioned, our general weight in all of the portfolios is equal weight across all 11 sectors. So typically when we start getting into our risk mitigation points, it's because all of those sectors start to fall simultaneously. So, Matt's, started our conversation off with correlations. What we start to see is a high correlation when, you start to see these massive drops, in the markets. So it's really a true systematic, issue across the economy. And it doesn't matter what sector you have, you're going to lose money. So that's where we'll start to trigger those risk mitigation levels. But on the individual sector levels, some are holding up a little bit better and they're rebounding a little bit faster. As Matt mentioned, some of our portfolios that invest at the sector level individually, we've got 4 of the 11 sectors invested as of today anyway. And they're the ones you'd expect, technology and healthcare, consumer discretionary, communications. So things like what we're doing right now, Zoom and technology, communications, they're doing really well. They're going to benefit from this particular circumstance here. It's interesting that that sector in general tends to be classified as an aggressive sector. You wouldn't think of it as a defensive sector under any normal circumstance, but again, we're not dealing with a normal circumstance here. So what historically would be aggressive is turned out to be very, very defensive. So that's been good. But we're going to start to see, a few of the other sectors rebound as well. As the economy does reopen, Matt mentioned there's a lot of value out there. And big investors with serious money, they tend to move into these categories, into these sectors when things get cheap. It's an opportunity for them. And, we're looking forward to that.
Good. Okay. Well, I promised about a 45-minute discussion. I genuinely appreciate Matt Goeller taking his time. He's a VIP at Vanguard, and we're glad to have him here. Chris, of course, I know you're always back at the lab some chemical is always being lit up. So I appreciate you taking the time. And of course, I'm going to unmute or ask Mr. Woolhouse to unmute himself so that he can say hello to everyone. Paul, go ahead, give everyone a hello. And
how are you guys? It's nice to be on the call and finally get started with this, even though it's a little strange with sort of the current situation having to be virtual, but looking forward to sort of building a relationship with as many of you guys as possible.
Great, thanks, Paul. And Paul is he is the shining example of 2020's college student right now, working from home. His internship was supposed to be here at the office. So for clients and everyone, you certainly will be hearing from Paul during the summer as he schedules meetings, and we're very glad to have him. I'll say thank you all again. Thank you for all of you who have joined in to hear from Matt and Chris live. And of course, we'll send out a replay of this after review with our friends at Vanguard, and do appreciate everybody being here. Have a great day.
Thanks, Lou.
Thank you.
All right. Thank you all.